Good afternoon and welcome to this week's edition of The Last Word. I'm your host, Paul Sanger. It's the end of another week and today I'm joined by Winston Summit from Uri Asset Management as Chris Goslin from Australian Fund Monitors takes a well-deserved vacation. We're here today to review the past week and peer into the future to see what might be on the horizon. Winston, welcome.
Thank you.
And thanks for standing in today.
Pleasure.
Now, Winston, it's been another strong week for global equity markets. The Dow Jones Industrial Average closed up overnight, again making its third record close of the week. But to kick things off, let's start with the key US data points that we've seen this week. The week kicked off equity markets-wise on a strong note, which was fueled by comments from Jerome Powell at Jackson Hole. He indicated that the time has come for the Federal Reserve to begin reducing interest rates. With inflation nearly under control and the job market cooling, the Fed appears ready to start cutting rates. The market's currently pricing in about a 75% chance that the Fed will cut the benchmark rate by at least a full percentage point from its current range by the end of the year. If the Fed does follow this expectation, you would need to cut the rate by half a percentage point or 50 basis points at one of its three remaining monetary policy meetings in 2024. How do you think this scenario will play out, and has the market misjudged the situation?
Well, it is a complex scenario, Paul. While the market's expectations are certainly grounded in the recent economic data, the Fed had historically been cautious about abrupt policy shifts. It'll be interesting to see if they proceed with the cuts and if they take more of a measured approach, especially considering the potential risks of lowering rates too quickly, which is something that they do worry about.
No, absolutely. And another key focus for the market this week was NVIDIA's earnings report, which exceeded expectations, driven by the strong demand for AI chips. And despite some production challenges, NVIDIA reassured investors about substantial revenue from its next generation AI chips. However, despite the positive earnings, shares have declined in the subsequent days. And some are suggesting that NVIDIA is priced for perfection, and perhaps the markets are feeling a bit top-heavy heading into September. Would you think that's a fair point?
Yes, it is. Look, I think a number of stocks investors fall in love with at certain points in time, and expectations really go way beyond the reality. And even though the result that came out was strong, the market starts pricing in perfection and leaving little room for error or even slight underperformance. In NVIDIA's case, while the fundamentals remain strong, the stock might be experiencing some profit taking as investors reassess their positions ahead of potential market volatility in September. And so they're locking in some of the profits. Yeah,
there's definitely that thing that people are, a little bit worried about what goes on in September. And let's move our focus to the domestic markets. And following events in the US on Friday, Australian markets are now pricing in a one interest rate cut by Christmas and a total of 3 cuts by May. And this suggests that traders are sceptical of RBA Governor Michelle Bullock's recent statement that interest rates are unlikely in the coming months. Earlier this week, we had the July CPI print. CPI rose to 3.5%, up from 3.8% the previous month, but exceeding analysts' forecast of 3.4%. Significant price increases were observed in housing, 4%, food and non-alcoholic beverages, 3.8%, alcohol, tobacco, and transport. What's your take on this, Winston? Who's right, who's wrong?
Well, unfortunately, in markets, there's some people are right and some people are wrong. The higher than expected CPI certainly complicates the RBA's position. While the market is leaning towards rate cuts, because that's what they want, the inflation data suggests that the RBA might need to stay cautious. The balance between supporting economic growth and keeping inflation in check is delicate, and it'll be interesting to see how the RBA navigates this in the coming months.
Yeah, it's going to be all eyes will be watching that sort of power struggle.
Yeah.
And upcoming economic indicators we've got coming include the retail sales report for July, due out later today, and the Q2 GDP report scheduled for next week. And aside from that, it's also been a big week for corporate results on home turf. MinRes came out this week, reported an underlying net profit after tax of 158 million for the year, which is down from 769 million the previous year. The significant slumping earnings and the doubling of the net debt led the company to forgo a final dividend to shareholders. On the flip side, we've had Flight Centre, which easily met consensus forecasts and rewarded shareholders with a more than doubling of dividends to 40 cents per share. Coles reported record earnings of 1.1 billion, which is a 2.1% increase on last year, and will also pay shareholders 3% more in total dividends for the 23-24 year. Nine Entertainment was another one, confirmed that the country's media sector is struggling with declining revenue and earnings. However, unlike his rivals 7-10, Nine will still pay a dividend, albeit at a lower rate of 8.5 cents for the year. What do you think? Is a bit of a mixed bag there for different sectors? Can you hear your thoughts?
Very much an issue of different sectors being affected differently. So there are different impacts, varied impacts of the current economic environment on these sectors. Companies like Mineral Resources are feeling the strain of higher debt and lower earnings because as interest rates have been up, they've got to pay more for their debt. And leading to tough decisions like suspending dividends. Meanwhile, Flight Centre and Coles have managed to navigate the challenges more successfully, rewarding their shareholders with increased payouts. The media sector continues to face headwinds, but Nine's decision to maintain a dividend, even at a lower rate, suggests a commitment to returning value to shareholders despite the difficult conditions.
Yeah, and let's move on to into commodities. In the commodities market, the gold price continued to creep higher this week. I think it's up 7% for the month and 23% year to date. Nickel was a star performer with solid gains this week, ending the month up nearly 8.5%. Iron ore, we talked about last week, everyone was bearish, but he surprised the market this week after all that negative chatter, and it broke through the $100 mark this week. Oil prices, meanwhile, oil prices were revised down with Wall Street's outlook on crude oil becoming more pessimistic. I think both Goldman Sachs and Morgan Stanley raised their price forecast downward due to anticipated increase in global supplies, including potential boosts from OPEC. So plenty going on the commodities front. And let's talk a bit about what we're going to expect next week. Looking ahead to next week, what are we expecting?
Next week is expected to be fairly quiet due to the upcoming Labor Day weekend, but there could still be some volatility driven by key earnings reports. Additionally, Federal Reserve officials will get a fresh look at their preferred inflation indicator, the Personal Consumption Expenditure, or PCE, price index. Whilst the Fed considers a range of indicators to gauge inflation, the PCE index is particularly significant in their quarterly projections. This data could indeed influence the September rate decision, depending on how it aligns with the Fed's inflation goals.
Okay, so we're all eyes on that. But as I think the key thing to what we're saying is it's all about the data. The market is watching every data point, and it will have some different implications on how the next few months pan out.
Correct.
Now, Winston, thank you so much. It's been a comprehensive discussion, and I really appreciate your insights. As always, we'll see how the markets respond in the coming days.
Thank you.
That's all. That wraps it up today for this week's edition of The Last Word. Thank you for joining us, and we will see you next Friday.